Welcome to another episode of Venture Capital, How It Works. Today, we will be discussing how startups go from an idea on paper to a publicly traded company, focusing on all the funding rounds from startup to IPO. This journey is often misunderstood, so we'll take you through the stages: pre-seed, seed, Series A, B, C, and even mezzanine financing, breaking down what happens at each round and how companies secure the funds they need to grow. Whether you're a founder looking to raise capital or an investor trying to understand the process, stick around because this episode is packed with insights. Let's dive in. The first stage of the funding journey is the pre-seed round. At this point, the startup is often just an idea or at the very early stages of development. Typically, the product is not yet built, and the team might still be coming together. Pre-seed funding is often raised from friends, family, or angel investors, people who believe in the founders and their vision. Occasionally, there are also pre-seed venture capital firms that specialize in these early-stage investments. However, the amounts raised at this stage are relatively small, typically ranging from $100,000 to $500,000, though it can vary. Key goals at pre-seed: develop the product prototype, conduct early market research, and refine the business model. Investors, friends, family, angel investors, early-stage VC firms. Risk is high. The company is in its infancy, with limited proof of concept or traction. At this stage, investors aren't looking for a fully fledged business, but rather a team with a strong vision and the potential to execute that vision. Next, we move on to the seed round, the first official equity funding stage. By now, the startup has a bit more structure. Maybe they've developed a prototype, tested the market, or even onboarded a few early customers. The seed round provides the capital necessary to build a minimum viable product, MVP, or to take that MVP to market. Typically, companies raise between $500,000 and $2 million during this stage. Seed investors often include angel investors, early-stage venture capital firms, or sometimes incubators and accelerators. Key goals at seed stage: build out the MVP, prove market demand, and prepare for scale. Investors, angel investors, micro VCs, accelerators. Risk is still high, but there's now some validation through market feedback or early customers. Startups at this stage need to focus on key metrics: customer acquisition cost, lifetime value, and early revenue if applicable. Investors want to see that there's potential for growth and a plan to get to the next stage, typically Series A. Now we enter Series A, the first significant round of venture capital funding. By this point, the startup should have a working product and some level of market traction. This could be user growth, engagement, or even revenue. Investors in a Series A are looking for more than just an idea or a prototype. They want to see a business with proven demand and the potential for long-term success. Series A rounds usually range from $2 million to $15 million, though in today's market, some rounds can be even larger depending on the sector and location. Investors during Series A tend to be more traditional venture capital firms with experience growing companies from early stage to maturity. Key goals at Series A: scale the product, expand the team, enhance marketing and sales efforts, and grow the user base or revenue streams. Investors, early stage venture capital firms. Risk is medium. The company has product market fit, but needs to scale efficiently and sustainably. Startups at this stage must have clear goals for how they plan to use the capital, whether it's growing their user base, entering new markets, or building a more robust product. After proving product market fit and scaling to some extent, startups often proceed to a Series B round. This stage is all about scaling and optimizing. Companies at this point have already found their core customers and have started to generate significant revenue, but they need capital to expand further, whether that's growing the team, entering new markets, or scaling operations. Series B rounds typically raise between $10 million and $50 million, depending on the industry and growth potential. Investors at this stage are looking for companies that can scale rapidly, with a focus on improving operational efficiency, customer acquisition, and expanding the market footprint. Key goals at Series B include expanding into new markets, hiring more talent, and continuing to optimize operations to scale rapidly. Investors at this stage are usually larger venture capital firms, sometimes with the participation of private equity investors. The risk is lower than in earlier stages. The business model is proven, but scaling introduces its own challenges. At Series B, the company is moving from a scrappy startup into a more structured business, often focusing heavily on refining processes and achieving more sustainable growth metrics. By the time a startup reaches Series C, it's a mature company looking to go global or diversify its product offerings. Companies at this stage are often raising between $50 million and $100 million, though it's not uncommon to see even larger rounds in industries like tech or biotech. Investors in a Series C are often larger venture capital firms, private equity hedge funds, or even investment banks. The goal at this stage is to scale quickly, often through acquisitions, partnerships, or even expanding into new markets and verticals. Key goals at Series C include market expansion, acquisition of other companies, and further product diversification. Investors at this stage are typically late-stage venture capital firms, private equity, and hedge funds. The risk is moderate. The company is established, but significant expansion efforts or acquisitions can still carry risks. At this stage, the company is preparing itself for an exit strategy, which could be an acquisition by a larger company or an initial public offering. Investors are less concerned with product market fit and more focused on the company's ability to dominate its market or enter new ones. Before we get to the final step, IPO, there's one more potential round of financing called mezzanine financing. This round is not always necessary, but can be crucial for companies that need additional capital to bridge the gap between late-stage funding and their IPO. Mezzanine financing is a hybrid of debt and equity, providing the company with the flexibility it needs to push through the final phase of private funding. It often comes from venture capital firms, private equity, or investment banks. The terms can be quite flexible, and it allows the company to raise capital without giving away as much equity as in earlier rounds. Key goals at the mezzanine stage include bridge financing for IPO or acquisition, and funding to push through any final growth hurdles. Investors at this stage are typically venture capital, private equity, and investment banks. The risk is low to moderate, depending on the company's IPO prospects. This financing stage typically occurs when a company has clear visibility of its exit strategy, but needs an additional capital injection to ensure a smooth transition to the public markets. The final stage in a startup's funding journey is the initial public offering. The IPO is when a company makes its shares available to the public for the first time on a stock exchange. This is often seen as the ultimate milestone for startups, allowing them to raise significant amounts of capital while providing early investors and employees the chance to cash out their shares. Before an IPO, the company must go through an extensive preparation process. This includes working with investment banks to set the stock price, preparing financial disclosures, and conducting a roadshow to pitch to institutional investors. It's a complex and expensive process, but it can dramatically increase the company's visibility and capital base. Key goals at the IPO stage include raising significant capital, providing liquidity to early investors, and establishing long-term growth plans as a public company. Investors at this stage are public investors, institutional investors, and investment banks. The IPO itself can be risky. Market conditions and investor sentiment can greatly influence a company's valuation. After the IPO, the company is now accountable to public shareholders and must meet strict reporting requirements. The capital raised during the IPO can be used to fuel further growth, pay off debts, or even make strategic acquisitions. And there you have it, the journey from pre-seed to IPO. From the initial concept to scaling your business and finally going public, each stage of funding plays a critical role in a company's growth. It's important to understand the dynamics at each stage, both as a founder seeking capital and as an investor looking for the next great opportunity. Remember, venture capital is not just about the money, it's about finding the right partners who can help guide your company through the challenges of growth. If you found this video helpful, smash the like, subscribe, and have a nice day. Until next time.